Hi everyone, and welcome to our training video with Nadal Rashid on the 3 pillars of building a profitable property portfolio. In our previous video, we discussed the 3 phases of investing. So we discussed how you would go from buying equity generating properties like residential homes to then moving into cash flow generating properties. So particularly things like commercial style of investing where it's going to give you a cash flow that you can rely on. And then we also spoke about how you'd get into developments and projects where you get to manufacture equity by adding value to the properties. In this video, it's a little bit different because I'm going to be discussing the elements of what makes an investment come together, particularly around growth, yield, and tax effectiveness. So this video is specifically for people who are looking at a passive style of investing. So if you're looking at buying a property as a buy and hold where you can put it in your portfolio and let it run its course without you necessarily having to do much work to it, then this video is going to be great for you. If you're looking at doing renovations or developments or no money down strategies, then this might not be as relevant. However, the elements in here still apply to when you're purchasing any kind of property. So it's still worthwhile for you guys to listen in and absorb as much of this as possible. So jumping straight into it, basically we have 3 pillars when it comes to investing. Number 1 is growth, number 2 is yield, and number 3 is tax effectiveness. So when it comes to growth and yield, there is a general rule of thumb. All right. So basically when you're buying close to a capital city, you can expect more growth, more capital growth on the property, whereas you're going to get less yield. If you're investing further out from a city, you're generally going to get a higher yield but lower potential for capital growth. Now, I'm going to break down the elements and talk about them specifically. So when it comes to growth, there's really 2 types of growth that we're working with. Number 1 is organic growth. Organic growth is what happens in the market naturally. That's when, people are moving into the market, there might be limited supply, there's more demand, and it's going to put pressure on pricing and it's going to go up in value. That will happen, across the board. In fact, over the last 100 years, property prices have always increased. Yes, they do dip along the way. Yes, they don't always grow at a consistent rate. But when you go far back, you've always had enough growth in there to justify hanging on to it. Now, as you know, with property investing, it's more of a longer term strategy. So property investing isn't something that you get into today and you make a profit tomorrow. In fact, sometimes it takes years before you get to realize some really good returns on it. The entry costs and the exit costs of investing in property is quite high. So generally speaking, when you enter into a transaction or enter into a property deal, you want to be certain that you're going to be in that property deal for a considerable amount of time. Now, yes, there are strategies where you can flip properties and be in and out of deals with no money down and all that kind of stuff. But like I said, this video is specifically for those who are looking at the longer term view and the longer term strategies of buying a passive style of investment where they're buying, holding, letting it run its course. So first part of growth is organic growth. That's just what happens naturally in the market. Every state differs. Some states are going to get 3 to 5% growth. Some are going to be 5 to 8% growth. Some might be more. In today's market, obviously it's very unpredictable right now because no one has a crystal ball to tell you what's going to happen. But look, we're always bullish on property because we know that if we're buying property now, it's not with the intention of making a profit on it tomorrow. It's really for the long term. So first type of growth is organic growth. The second type of growth is manufactured growth. And manufactured growth can happen directly or indirectly. And what I mean by that is if you buy a property and you add value to it by doing something like a renovation or a extension or by doing a subdivision or getting a development approval on it, then you are directly influencing the growth of that property, meaning you're improving its value by adding value to it. The way you would get indirect manufactured growth is when you are almost at the right place at the right time. So for example, you might own a property on a main road which gets rezoned, and all of a sudden all these houses nearby are getting knocked down and redeveloped into apartment buildings or commercial buildings, and all of a sudden your property is worth a lot more because it's worth a lot more to someone else who can potentially turn it into multiple properties or property with a different use. So you get some really good manufactured growth. Or you might be across from a development site where your house has got, a reasonable amount of land, let's say a standard size block of 600 square meters. A developer comes in and takes a big parcel of land across, the road from you, and they start off selling 300 square meter blocks at, for example, $200,000, and then they release another stage. Now it's selling at $220,000, and then release another stage, and now to $240,000, and they start increasing the square meter rate on the land. Then you, by default, being across the road from, are going to get the benefit as well. So manufactured growth can happen either directly or indirectly, and organic growth obviously happens just with the way the market unfolds. So when it comes to growth, there's obviously there's unlimited potential there. Now, when you are investing for capital growth, look, if you are on a low income and you're buying a property just with the just on its growth potential, you just have to be mindful that you're not negatively gearing yourself too much, or paying too much for the potential. So what do I mean by that? Like I said at the start, when you're buying closer to a capital city, you got more potential for capital growth, but lesser yield, right? So by having a lesser yield, which we'll go into in a second, means that the property isn't going to be making as much of a return. So it's going to require you to keep feeding that investment some money. Whereas if you're in a low income and you're buying and you bought a negatively geared property, and all of a sudden you have to keep supporting that by $100 or $200 a week, you can't sustain that for too long. Whereas if you've got a good yield on the property and the rent can look after its own expenses, then it doesn't matter, because the property can look after itself. And that takes us into the next point, being yield. Now, the yield is really dependent on the rents. So as an example, let's say you buy a property for $500,000 and that rents out at $500 per week. Then, that's 25 grand a year. Divide that by the purchase price of the property of 500. That means it's a 5% yield, which is, in today's world, it's enough to cover all of its interest costs as well as its property expenses, and break even, or even in cases give you a bit of cash left over to put towards the principal, right, and start paying that loan down as well. Now, like I said, with high yielding properties, generally if you're looking further out from the city, you can get some really good passive cash flow deals, but you're going to sacrifice a little bit on the growth because you're not going to get the same growth. So as an example, you can buy a house in Norwood for $800,000. So Norwood being only, 4Ks out of the city. Let's say the purchase price is $800,000 and you rent that property for $450 to $500 per week. That's going to give you a 3% yield. All right. Now, the reality is that property in Norwood is going to go from 800 to $1 million over the next, say, 5 years. So there's some good potential capital growth there. And then when you work out 200 grand over the next 4 or 5 years, that's a $40,000 to $50,000 uplift in capital growth. So that's a fair chunk of capital growth, but you're going to be negatively gearing yourself by a couple of $100 a week to keep feeding that property whilst, so you might be losing, say, $5,000 to $10,000 a year in cash flow, but you're making that up on the growth. On the other hand, you can go for a positive cash flow property. So go for a property in Elizabeth, for example, where the purchase price is $250,000 to $300,000, and you're going to rent that property for $320 to $350 per week. So that property is going to be making you, say, 15 grand worth of income. So let's say 15 to 20,000 worth of income, but the expenses on that's going to only be about 10 grand a year. So all of a sudden that property is making you 5 grand cash flow, or $100 a week. So you're making $100 a week, but you're missing out on the capital growth. Now, which way is right? Look, there's no right or wrong way. Okay, it really depends on your starting point. If you have the ability to borrow money, borrow, a fair chunk of money, and you're on a high income, let's say you're on a 6-figure income and you've got tax problems, then you probably don't want to go for a positive cash flow deal that's going to make you an extra $100 a week, because it's not going to move you ahead as much as going for something that's going to be a high growth property. Whereas if you're on a low income, let's say you're only earning $40,000 a year and you're a single parent, you've got 2 kids, and you're wanting to find something that's going to give you an extra couple of $100 per week, then maybe a positive cash flow deal is going to be more ideal, because then you're not really banking on high growth, but you just want something to start giving you another income on the side. So that's what I mean. There's no one size fits all. It really is dependent on your personal circumstances. So before you make any investment decisions, always consult with some professionals to make sure that you have the right advice before you transact. Because once you've transacted, it's a very costly exercise. The cost of the transaction on the way in and on the way out is quite expensive. So it can be an exercise that actually puts you back if you don't get it right. Cool. And then the third strategy is when it comes to tax effectiveness. Now, the tax effectiveness might not necessarily apply to every person because, again, if you're that low income earner, you're not making enough cash, you're not paying any tax, and you are, really just starting out, maybe the tax effectiveness part doesn't really come into play. You might only sort of work on the yield. Whereas if, let's say, again, you're in a high six-figure income, you've got some tax problems because you're paying a lot in tax, you don't have any ways to reduce that, and you are looking for some strategies to do something about that, then maybe a brand new property might be ideal. There's two ways you can get some tax benefits through property. You can either go through a negatively gear yourself, meaning you find a property that earns less than what it costs, and the shortfall becomes the negative gearing amount, which you can claim off your taxable income. Or the other way is to actually go for a brand new property which has depreciation benefits. So as you know, brand new houses have brand new appliances, they have brand new fixtures and fittings, and as they get used, that depreciates on paper. So it's not a physical cash cost, so it's not costing you out of your pocket. Now, as it depreciates on paper, that tax depreciation becomes a tax write-off. So, for example, if the property depreciates by $10,000 in that first year, that's 10 grand that comes off your taxable income. So if you're making 100 grand, you don't get taxed on 100 grand anymore. You get taxed on 90 grand. So, there's about a $3,700 tax refund that you could expect off that. So that's what I mean by understanding your financials before you make any decisions on which way to go. So that's why in the previous exercise, when we did the roadmap, we worked out where are you now, where you want to be, what's your financial position look like. So that's why we had to break down your assets, your liabilities, your income and expenses. And then by doing that, it allowed us to work out what kind of capacity you have. Because based on your capacity, that's generally what dictates what you can purchase, right? If you're relying on bank funding. Now, obviously, there's other strategies which doesn't require bank funding, but for this exercise, we're working off the banks giving us money to be able to fund this as a straight out purchase. So, just as a bit of a recap, 3 elements to every investment: growth, yield, tax effectiveness. The growth is what we're banking on for future, right? And that happens at a later date. So you only realize that growth when you come to sell or refinance. Yield is the cash flow element of the deal. So that's how much cash it's putting in your pocket along the way. And then tax effectiveness is what's happening at the end of the financial year. So when you come to submit your taxes, how much money is it saving you on tax, or is it adding on tax, right? Because again, depending on your financial situation, that is going to dictate what type of investment you go for. So as a bit of homework and as in terms of next steps, what I recommend you do is look over the videos where we go through running the numbers, right? In running the numbers, I actually break down those 3 components in greater detail. So I talk about the growth and I put a predicted capital growth rate in there to show what that property is going to do over a 10-year period after we've purchased it. I also look at the yield, or more so the income. So how much income versus expenses we've got coming out of that property. And then the third thing I look at is the tax depreciation and what that means for us before and after tax. So have a look through those videos. As always, if you have any questions or any queries or you need any help, feel free to shoot me an email or give me a call or just reach out, whichever way you like. And I hope you got some value out of this. All right, I'll see you guys on the next video and best of luck. Chat soon.